You must have likely caught the buzz in recent news. The US stock market is dangerously overvalued with sky-high PE ratios. Is the US market's lofty heights a house of cards waiting to tumble, dragging India's Sensex and Nifty down with it? As JPMorgan and BlackRock sounded the alarm last week, let's dissect this step by step, with a sprinkle of humor, of course. After all, the bigger they are, the harder they fall. And boy, do we love pretending it's a surprise? At Hedgenomist, we are thrilled to deliver razor-sharp insights into evolving market trends and their real impact on you, arming you with tools to fiercely protect your investments and supercharge your financial edge. If it's your first visit, hit subscribe and ring that bell now. Recently, news has buzzed about the US stock market's overvaluation, with warnings of an impending crash due to sky-high PE ratios, AI-driven tech hype, and experts' predictions of a bursting bubble. This raises concerns for Indian investors as foreign capital flows heavily influence markets like Sensex and Nifty, prompting questions about how a US downturn could trigger sell-offs here. As 2025 wraps up, JP Morgan's chief highlights vulnerabilities in credit market echoing past AI-fueled bubbles. BlackRock cautions on stubbornly elevated valuations amid geopolitical tensions and overinflated tech sectors, suggesting a downturn might already be underway. Goldman Sachs flags risk from gains concentrated in a handful of giants. And Michael Burry, you remember him? The famous one which predicted the 2008 crisis, has taken shorts on Nvidia and Palantir. They are trading at 60 and 600x PE respectively. For India, this pattern is all too familiar. US turmoil often sparks panic selling here. But this time, for us, there are two problems. Besides the global turmoil, in India, a key market risk stems from mutual funds channeling inflows into a narrow set of large cap stocks to buoy benchmark indices and safeguard portfolios. It offers stability in short term but has heightened vulnerability amid global uncertainties. Over the past 5 years, equity inflows have surged, with 2025 alone recording about 2.7 lakh crores, fueled by record SIP contributions that reflect strong retail enthusiasm. However, alarmingly, half of this year's inflows have been concentrated in just 19 stocks like SBI, Reliance, and Swiggy, inflating their valuations and supporting Nifty and Sensex levels. While this strategy enhances index performance and attracts more investors, it exposes millions of retail mutual fund holders to concentrated risks. A US market downturn or global slowdown could trigger sharp 10 to 20% plus declines in these stocks, eroding fund values and amplifying broader index drops, and eroding savings for all of us. Let's dive into the potential impact on Indian markets, its ripple effect that could sting but not necessarily sink us. Financial experts warn that a US market bubble bursting might spill over, slashing consumer spending and confidence here in India, while aggravating inflation and sluggish fund inflows. Capital flight could further weaken the rupee, spiking import costs, and it could drag the globally connected sectors like IT and exports. We are talking a possible 10 to 20% dip across the indices, with even steeper falls in volatile pockets. But India's solid fundamental might turn this into a healthy correction rather than a full-blown crisis. Before moving on, let's sketch two scenarios to see potential fallouts. Exciting to game out but sobering as well. In case of a mild US dip of around 10% sparked by tighter policies or trade spats, India's Nifty or Sensex might slip by just 5 to 10%, cushioned by steady domestic institutional flows and retail buying sprees. Yet, if panicky newcomers yank their SIPs, it could spike to 15%. In case of a severe US plunge of 20% plus, driven by economic slowdowns or escalating tensions, expect a sharper 15 to 25% Nifty hit, slamming mid and small caps hardest. US reliant sectors like IT services, pharma, and auto components would suffer most, with overall liquidity drying up, the rupee weakening, and inflation flaring. But India's projected 6.5% GDP growth for 2026 offers a solid rebound foundation. Remember, foreign outflows sting, yet stronger local support these days softens the blow. So what's the smart move? If your portfolio is heavy on tech, pharma or textiles, sectors which are vulnerable to global jitters, pivot to diversify for rock solid stability. Think FMCG, banking or utilities. These thrive on our robust domestic economy and expanding middle class, shielding you from international jitters. In a nutshell, a US market tumble could spark 10 to 20% swings in India, steeper in volatile zones. But our built-in buffers might keep it as a quick reset. Stay sharp on valuations, eye key sectors, and balance your bets. Market dip short term, yet reward the patient. Boost your know-how and hang tough. Thank you for tuning in and invest smartly.